welcome to the FII View. My guest today on the show is Michael Parr, who's the Chief Investment Strategist at Investec Asset Management. He joins us from London. Michael, it's great to have you on the show. Thanks very much for taking out the time. My first question to you is, and that is really related to the big talking point of late, which has been the dollar. Is this dollar strength that we are seeing reflective of underlying fundamentals in the US improving? Or is it reflective of risk aversion on account of a possible QE withdrawal by the end of this year, perhaps?
I think the latter is by far a greater influence on the relative performance of the dollar this year. There may be a little bit of improvement in the US economy. It's also worth pointing out that the dollar hasn't actually been the world's strongest major currency this year. The renminbi has that claim. But nevertheless, in the world of trading, which we're all part of, yes, the dollar has been strong, and yes, mostly because it is the funding currency, the unit of account for most investments worldwide.
Michael, the Fed had stated that its policy is not predetermined and is data dependent. On the recent data of the last 6 months, do you think it's sustained improvement that we are seeing in the US economy? Do you think data is sustainable, or is it a bit disguised as it comes on the back of the Fed's commitment last October that they would continue to buy bonds and infuse liquidity till the economy actually improves?
I think much of the US economy's performance in recent years, especially in the last year, has been driven by the accommodation that's come from the Fed, though there is some probably underlying improvement in things like the property market. There has been some improvement. I do worry that the talk of tapering, as we are now faced with, may tighten up things like mortgage rates and may actually prematurely stop some of that improvement. So the data for the next 3 months and to see whether any effect of the tightening or the prospects of tightening have changed that data is going to be very important.
Of course, the other aspect then is the fall in EM currencies, especially the rupee. How much do you think this fall is related to domestic factors, and how much do you think is led by dollar strength globally?
Rupee, Turkish lira, South African rand, Brazilian real, a lot of emerging markets have been caught up in the last few weeks. I think by and large it's been due to the withdrawal of the external flows. But nevertheless, in Turkey and South Africa and Brazil, not really in India, there have been local factors that have somewhat aggravated these flows. And I think that's probably why they've probably done, I think, even worse than the rupee.
So give us your sense on allocations. Will we see money over the next 6 months shift towards developed markets from emerging markets, or this outflow is only for the near term, you think?
Look, I think over the next few months that will happen. By default, there will be an upweighting relatively of developed markets versus emerging markets. But I think essentially it's a flight to not if quality but safety, or perceived safety. And I think over the course of the next year you will see a bottom reached in the allocation towards emerging markets and possibly re-engagement even by the end of this year.
Okay, let me drill it down to specifics then. Where do you see the dollar, the S&P 500 and US Treasury yields by the end of this year?
It depends on whether the US economy improves or whether it stalls. If it stalls, the prospects of withdrawal of QE suddenly recede, and we may actually see people go back to bonds. We may even see people leave the dollar, and we may see S&P actually improve. If it continues, the S&P probably might start to improve a little bit as well. The dollar might continue to strengthen. But the real question is, if Treasury bills in the United States start to go up to 3% and above, whether that actually starts to break the recovery of the United States economy and puts all those sorts of things like the S&P and the dollar on hold.
How much, in your opinion, Michael, how much of this nervousness or volatility in markets and asset classes is a phase of adjustment and price discovery, sort of a transition as the possibility of policy change increases? And if so, how long could this phase last?
I think it depends on each market, but there is some truth in how you phrase it. I think that we will see individual countries adapt to specific needs that they might have in order to make themselves more attractive to investors. And India, of course, is doing that very much at the moment. In fact, India is probably doing more than most. In the past, there's always been a sense of ambivalence as to whether the Indians truly welcome foreign investment. I think that ambivalence is starting to fade, and I think that foreigners are much more welcome than they used to be.
Well, Michael, we'll take a short break on that note, but when we come back, we will talk to you about your specific EM outlook.
ASEAN in itself is becoming a very interesting destination, and I think that simply because the region is starting to function more as a unit as time goes by, and countries like Myanmar and Vietnam are very much becoming part of the total story, is making it more and more attractive as time goes by. I see certain forecasts that essentially say that within 20 years ASEAN may have an economy that's as large as, if not larger than, Europe.
Welcome back. You're still watching the FII View, and I'm still in conversation with Michael Parr, Chief Investment Strategist at Investec Asset Management. Michael, what is your view on emerging markets? Are funds moving outside of BRICS as a percentage of their overall EM exposure?
I think that's probably happening, though the move is very marginal, and at the moment it's very difficult to tell where they're moving, if they're moving within the emerging market community, because mostly we're facing withdrawals. But I do think that the attractiveness, or the relative attractiveness, of many of the non-BRIC emerging markets and even the frontier markets is something which investors are starting to look at much more closely now than they were a few years ago.
So which are the new markets where money is flowing in the broader universe of emerging markets, or even within Asia?
Well, of course, there are Asian emerging markets, and the first one that came to mind in my case was probably Indonesia. I think that ASEAN in itself is becoming a very interesting destination, and I think that simply because the region is starting to function more as a unit as time goes by, and countries like Myanmar and Vietnam are very much becoming part of the total story, is making it more and more attractive as time goes by. I see certain forecasts that essentially say that within 20 years ASEAN may have an economy that's as large as, if not larger than, Europe. So I do look at what's happening in Southeast Asia and think it's a very attractive destination. It's not the only one, but India, I think, as well, if it can overcome this ambivalence, which I talked about before, could become a very attractive destination again for foreign portfolio investment.
Michael, put more perspective on the concerns coming in out of China. China raised considerable debt in Q1 of this year. The concerns over China's credit markets and its slowdown, given that China is one among the few markets that has a current account surplus, do you think that they are far-fetched?
I think they are justified because the sheer volume of credit that was created was endangering the Chinese story, at least the extent of the Chinese story. But I think the actions by the People's Bank of China over the last week, essentially wagging its finger very sternly at the second-tier banks and telling them they should not create so much new credit, usually through what's called wealth management products, has probably stopped this becoming a real problem. The question now is whether their reining in of the credit turns what is a slowdown in the economy inside China into a hard landing. And I don't think it will, because as we saw over the last couple of days, they can be soft as well as hard. And they have essentially injected liquidity back into the markets, and the interbank rates, for instance, have come back to much more reasonable levels.
But how do you view the China story and its influence on world markets? Is the China slowdown good or bad for world markets? How much of an influence can it have? And also the impact the China slowdown can have on commodities.
Look, I think in general, the slowdown in the rate of growth, which is still very considerable, let us not forget, but nevertheless obviously plays especially into the commodity-rich countries, not just in the developing world, but places like Canada, Australia, Norway, New Zealand have also suffered. And I think that that's something which they will continue to suffer until we find a new base. I don't think that the recovery is going to be a particularly sharp one, and here I'm talking about in commodity prices, but I do think that the commodity story is not going to go away. It's mainly become, at least for now, more of a volume story than a price story, and I think that does mean a different type of investment is what attracts investors. The companies that have large volumes of production are increasing that volume of production and are doing so at efficient levels are going to be far more attractive than the marginal players.
Right, so how do you rate the BRIC story among emerging markets now?
I think the BRIC acronym was one that worked wonderfully well for a relatively short space of time. But one thing that we've realized in this latest withdrawal of liquidity from emerging markets has truly shown that up again, is that all emerging markets are not born equal. And as soon as you start to think about the BRIC quartet, and I really don't, even though I live there, include South Africa in it and make it a quintet, you realize that essentially it's a Brazil, Russia on one side, India, China on the other side story. The Brazil-Russia is more about commodities. That's what dominates their exports. And the India-China story is more about people. That's what dominates their economic profile. And I think that it was just, the BRICS story was just a convenient acronym. That said, the BRICS are an incredibly important part of the total weight in, for instance, the MSCI index. And that does mean that those people who do follow that index are almost automatically forced to take much heavier decisions about Brazil, Russia, India, China than they are about the other emerging markets.
Of course, the other big talking point has been the yen and Nikkei. You know, the trade for the year, you think, has played out, or is there some more to this trend?
Oh, there's much more to go there. I think that the elections in Japan, which I think for the upper house are next month, will then, if the Liberal Democrats win the control of all three levels of government, that will make it far easier for them to fire a much more convincing what's called third arrow in Abenomics than they fired up until now. The structural reforms that Japan needs are root and branch. And if they are going to follow through the first two arrows with root and branch reform, it is possible you will see the yen go down even further and the Nikkei go up. But as you know, both have reversed in recent years, and we're now back into bear market territory in terms of a 20% down move in the Nikkei, and the yen does not seem to be weakening at the moment. The other thing I always say on this one is watch out for the responses that other parts of Asia in particular will have towards a weakening yen. So I think the Koreans and their won and the Taiwanese and their dollar are not to be underestimated in their determination to actually counteract some of the effects that a more competitive yen has had on their export profile.
Michael, on that note, we'll take a short break. But when we come back, full tilt, talk about India and its macro outlook.
I think banks in particular are looking interesting, though, of course, while interest rates are declining, banks always tend to have a tougher time of it. I probably would be more interested in the areas of consumption. I think that the telecom story in India still has some way to play out. And I think that when you do see a recovery in property, as you probably will, obviously that plays into the cement sector. I think the retail sector in India is starting to look extremely attractive, and I think that those local companies who are probably not yet committed to joining up with a foreigner, and they might, are probably in the best space here.
Well, welcome back. You're still watching the FII View, and I'm still in conversation with Michael Parr, Chief Investment Strategist at Investec Asset Management. Michael, what's your view on India? Are you bullish or bearish from whatever has happened over the last 6 months?
I'm realistic, which probably means I've been bearish up until now, but I have to say in the last few days I've become a little less bearish. I do think that India needs to go through, and perhaps is going through as we speak, something of an equivalent experience to what Southeast Asia experienced in 1997, 1998 when they had the Asian crisis. I think the epiphany that India needs to have is that growth ultimately needs to be supported with a much more robust export performance than it has up until now, which means the need for a more competitive rupee is extremely high. And I think that part of the recent fall in the rupee has helped put India in a position where it can be much more competitive in its exports.
Michael, the RBI in India has cut 125 basis points in policy rates. Should it cut more, or given the concerns on CAD, trade deficit, the rupee, also the US yields rising, it may have its hands tied?
I think it's got its hands tied for the time being, but if the Indian economy starts to recover, there's not a lot of inflation out there, and I think the fall in the oil price in particular will have helped India. Obviously, there are some flow-through effects from a weaker rupee that still have to be washed out of the system, and I think the RBI will be very sensitive to that. but I would love to see India's rates come down more. My only concern is that lower rates would translate into higher credit growth, and truly what I want to see is, yes, maybe a little bit higher credit growth, but I want to see much more industrial growth.
Well, Michael, the euro showed strength despite the weakness in the eurozone due to the region's current account surplus. Do you think that despite what the dollar is doing, the fall in the rupee could be stemmed by an improvement in the current account deficit data?
I think that what's happening at the moment is you will see a reining in of Indian imports and a boosting of Indian exports, although global growth environment is not overly supportive of that. But I do think that you will see an improvement in the current account position of India, and I do think that that will lend support to the valuation of the rupee. There tends to be a J-curve effect, as economists call it, which mean that the positive side of this tends to be delayed somewhat. But I do think that probably within 6 months you will see quite a material increase or rather decrease in the level of current account deficit as a percentage of GDP, and that will support the rupee.
Do you expect the numbers on the CAD front to improve from here on in India?
I do. I do think that exports will increase and imports will be reined in, but there may be a slight delay on that happening.
It's interesting. I was just studying your sectors of preference in emerging markets, and you clubbed them as BBC, banks, breweries and cement. Also telecom you seem to like a bit. With regard to India, which are the sectors that interest you the most?
Look, I think that's just a way on which I characterize emerging markets, or at least early stage emerging markets, because that's the best way of gauging the temperature of their health. I think those are all attractive sectors. I think banks in particular are looking interesting, though of course while interest rates are declining, banks always tend to have a tougher time of it. I probably would be more interested in the areas of consumption. I think that the telecom story in India still has some way to play out. And I think that when you do see a recovery in property, as you probably will, obviously that plays into the cement sector. I think the retail sector in India is starting to look extremely attractive, and I think that those local companies who are probably not yet committed to joining up with a foreigner, and they might, are probably in the best space here.
Michael, there's been a big deal in the breweries sector in India with Diageo buying India's United Spirits. Do you think that such opportunities in the future will interest you, especially in the local markets?
They do, very much as a question of being able to track the trends. And I think that to see where the foreigners are most interested is a fascinating story in and of itself. Do remember that the Indians have almost been giving as good as they've been receiving in this respect, and there are plenty of Indian companies active elsewhere in the world as well. So it's nice to see the two-way trade, and it's interesting to see how, for instance, Indian companies have been active in the African telecom space.
Well, taking that very thought forward on telecom, telecom in India, Michael, has gone through a painful phase. There seems to be some hope coming in for the sector now. Do you agree that the sector is at a turning point? And also, what do you make of Bharti's acquisition of Zain, for the future prospects of the company's business and, in establishing or strengthening its global presence?
I think it's a good bet longer term, though Bharti has brought a very different model to the African market than the one that prevailed there before. It's much more of a low-cost, high-volume model than existed. And this may shake things up, and it may move the markets in Bharti's favour. But telephone contracts tend to be very sticky. Once you've established your relationship, it takes a long time to shift them. And it's going to be interesting to see whether their low-cost model can actually cause existing subscribers to move over to Zain. Perhaps, but it's not an easy process to do. But nevertheless, I think that Africa will, longer term, no doubt be a relatively good place for Indian and telecom companies to have invested, simply because the African growth story is so strong.
Well, Michael, in India, a lot of financial companies are lining up for new banking licenses. What's the potential you see in this opportunity, given that you track banks in India?
I'm afraid where I see new licenses being dished out for banking, I don't see so many opportunities as threats. I'd love to see the existing players actually starting to sharpen up their act rather than huge numbers of new players come in. That's not to say I don't want to see fresh blood. Of course I do. But I often wonder whether banking licenses are being given out for the wrong reasons. Often conglomerates, getting banks which end up assisting them and help them fund their capital expenditure plans or their other borrowings, and I don't particularly like seeing that story. So I would love to see the banks stick at being banks, and I would love to see the foreigners perhaps being allowed in to a greater degree than they have been, and I would love to see great Indian banks like ICICI do better and then sharpen their offering as compared to their well, ICICI has had a great offering in the past, but basically stick to their knitting, and that's something I generally think is absolutely important in the world of banking.
Well, on that note, thanks very much, Michael, for taking out the time and speaking with us. Really appreciate your views. With that, we come to the end of this edition of the FII View, but we leave you with some reactions and opinion on the recent data that came out in the US.
Mr. Bernanke is most likely to retire, and some other Fed members, they make Mr. Bernanke look like a hawk. In other words, they're even more dovish, and they have argued for unlimited QEs forever. And I think that is likely to be the case. In my view, it is very likely that the US market has already peaked out at 1,687 on May 22nd on the S&P.
The non-farm payrolls, having come in as strong as they did at 195,000, definitely are going to focus people on the Fed starting to taper QE, possibly at the September FOMC meeting. So I think markets will remain on edge, particularly the fixed income space. We've seen, of course, quite a big adjustment already in yields, and my view would be that we've seen the major shock already, and that quite a lot of that news is already discounted. But I think we're definitely now seeing that with the jobs trending around 200,000, there's not really much excuse for the Fed to delay the onset of tapering. So I think the markets will have to face that. It's difficult to say how much more short-term reaction we might see when it finally does happen, but probably not as much as we've just seen when Bernanke drew attention first to that in May.
We probably won't see that until early next year, possibly on the very departure of Mr. Bernanke. Whilst the tapering effect will affect long-term bond yields, there's very little chance that short rates are going to move up over the next 18 to 24 months. So the Fed funds rate is anchored at a pretty low level now for the next 24 months.
The economic data has been a bit mixed, but generally it's been very consistent with what we've been anticipating, and that is a very low level of growth. The equity market has been responding to some of the comments made by the Federal Reserve Chairman about the prospects of tapering the asset purchase program that they've been conducting for some time. Our feeling is that the market will continue to respond to some of these kinds of statements, and even the movement of bond yields in the U.S., which most recently have been rising. So I think it's less to do with anything tremendous about economic growth and more about a range of other influences.